Well, what a great opportunity for all of you here today to listen to, and we hope that you'll engage in questions with post-session. 5 individuals. Corey Marcello, one of our favorite moderators, joins us here today from his new firm, which I have to read now, Corey. I can't rely on memory alone, but Katz, Sapper, and Miller. Corey is a New York office leader and an established veteran in middle market M&A. And with him today, we have four investors, one strategic, and 3 representing the private equity community. 2 stalwarts, who of course you know by name, and many perhaps in person, John K. Castle and Savio Tung. And 2 first-time appearances on our stage. Jennifer St. Pierre, who is in the news almost daily with what is proposed to be the largest technology M&A transaction of all time. I've promised not to ensure that that's not part of the conversation today, but I think important to call out, and Bob Morse, who's the co-founder and CEO of Stratum Capital. This session, as you would expect, we'll talk to what these investors have been doing over the last year, and equally importantly, or perhaps more importantly, what they see in the horizon ahead. With that, please welcome our next panel to the stage.
So the format of the discussions that we're going to have this morning is I'm going to do some introductions of our esteemed group of panelists. Then we'll have our discussions amongst us, and then we'll end with Q&A from the audience. So the first thing I'm going to do is let me give a brief introduction for each of our panelists, some of which aren't needed, but it's my job to do it. So John K. Castle is the founder, chairman, and CEO of Branford Castle Inc., a private equity firm, as well as Castle Harlan, a private merchant bank, which has employed more than 42,000 employees. Prior to forming Branford Castle and Castle Harlan in 1986, John was the president and CEO of Donaldson Lufkin Jenrette, DLJ, one of Wall Street's largest investment banks. He also served as the director of Equitable and other nonprofit organizations. Savio Tung is one of the founding partners of InvestCorp for 31 years, where he is currently the chief investment officer. InvestCorp provides international investors with corporate, real estate, and hedge fund investment opportunities in North America and Western Europe. He is currently in the boards of public companies and not-for-profit organizations. He's a member of the Council on Foreign Relations and an independent non-executive director of Bank of China, Hong Kong. Jennifer St. Pierre is the vice president of corporate development at EMC, currently EMC. She has over 10 years of experience in the tech industry, focused on strategic execution through mergers and acquisitions, strategic investments, and capital structure transactions, having led the closing of over $5.7 billion in transactions. Bob Morse, he's the co-founder, it's easy to pick out Jennifer, so I had to put. Bob Morse is the co-founder and CEO of Stratum Capital, a private equity firm focused on the IT market. And prior to that, Bob was the partner at Oak Hill Capital, where he was the head of their technology verticals and a member of the exec and investment committees. Myself, I'm the New York practice leader for Katz, Sapper, and Miller. My areas of focus are providing business advisory services to private equity firms and family offices related to their portfolio investments and funds, along with concentrating in the financial services and technology industries. Over my career, I've worked on over probably 300 plus deals. So, can each of you take a couple of minutes to describe for the audience where in the middle market your firm is investing in, and the industry areas that are of most interest for you and your firm? Savio, can you start?
Sure. First of all, good morning, and I want to thank all the sponsors and M&A advisors of having us here. Hopefully we can be more interactive. Not too much commercial on InvestCorp, but I do want to emphasize that we are a middle market private equity shop. the world is getting competitive, so I do want to put in a plug here. If you have good ideas, I want to hear from you. Some of the recent activities, if I could add, in terms of middle market, we have been quite fortunate. On the average, in the last 4 years, we have done about 4 transactions per year, and that's just about the sweet spot for us. Some of the companies are most recently a pre-K and K-8 school system called Nobel. We have about 170 schools in the United States. We also bought into a temporary staffing solution company called Pro Unlimited. On the technology side, we bought a company called Fishnet, which is really a security product distribution value-added reseller, which quite recently merged with another competitor with the sponsorship of Blackstone. We have also been very active in the consumer product side. We got into an interesting company, motorcycle safety product company called Danese. And last month, we did an add-on acquisition, buying up POC. For the skiers in the room, you'll know that's the sort of top end of ski helmets. And the two of them, we are creating quite a lot of synergy benefits in it. So that is indicative of what we're looking for, what we've been doing. I think that for us, these are the sectors that we'll continue to look at. We do have a smaller department within InvestCorp focusing on technology, but more growth capital and technology private equity. It's called InvestCorp Technology Fund 3. It was a $500 million. I think we have done a pretty good job. We are harvesting. Today, we are seeing 3 times the money back to our LP. So I think we are also very active in the tech sector.
John?
Super, just like Savio, I'm interested in seeing all of your transactions that are of the right kind and nature, and I'd love to talk to you about them. I'm active in 2 particular areas, one of which is Castle Harlan, which has traditionally done mostly transactions in the $100 to $500 million size area, and we call that the middle market. And historically, we've done a lot of. I hope that wasn't me, but anyway.
We're all looking at each other. Did you move? I didn't move.
Yeah, I must have frightened Savio or Jennifer or something. But anyway, we're always looking for businesses that are well established, have a strong proprietary kind of a position, has some moderate level of growth and so forth. Now, in addition to that, we have Branford Castle, and it typically focuses on companies that are somewhat smaller, below 100 million. And there are quite a few differences between the above 100 million and below 100 million size range. Above 100 million, you have sophisticated sellers usually, you have sophisticated investment bankers and lawyers and so forth. Below 100 million, you're more likely to be dealing with business brokers and other folks of that nature, and so we find that particular area is a very attractive one. The industries that we've been involved in are very broad. We have done a lot of things in the oil service area, which right at the moment isn't the best area to be in, but nonetheless an area that we've been involved in heavily. We've done many things in the restaurant area, many things in the general industrial area. We've done a lot of things in the distribution area. We own Baker & Taylor, which is the world's largest book distributor, enterprises of that particular nature. So there's very little technology that we get into in the sense of areas where there are rapidly changing technology. That isn't what excites us. It's what excites us is strong cash flows that we can optimize and grow. So that's my story.
All right, good. Now, Jennifer,
Great.
talk about the risk areas.
So slightly different than others sitting up here on the stage, right? EMC is a global enterprise leader focused on helping customers store, manage, secure, analyze their information. And so we do that through a number of different ways. We have a core technology group, which is focused predominantly on infrastructure, storage, and how people can store, manage, and look at their data. And then EMC is uniquely structured in that we have a federation of companies. So for those of you in the room that are familiar with EMC, we have VMware, which is a separate standalone public company focused on virtualization. We have Pivotal, which is focused on data and analytics. And then we have what we call EMC-II, which is your storage infrastructure group. EMC as an entity is $24.4 billion of revenue in 2014, and we currently have about 70,000 employees. And slightly different to what John said, right, I actually do get excited by technologies that are constantly changing because that is where we tend to make our investments that are strategically aligned to what EMC is trying to do. And I'm sure we'll talk about this a bit on the stage here, but we're in a bit of a unique time as you think about the technology space as the business is going through a transformation. You have kind of the core, what they're calling the second platform technologies, that are now shifting to third platform technologies, which are user-driven technologies. So instead of going to the CIO and asking the CIO, what do you want? The CIO is actually getting pressure from his users in the organization saying, no, I don't want to deal with that technology anymore. This is what I want to see. And so that's changing a bit of the landscape. It's changing a bit about how we look at the market. And so making it a very interesting time as we think about from an M&A perspective. In terms of the core areas that we're focusing on right now, clearly cloud services continues to be an area of investment, and what I'll call is software-defined, really you can fill in the blank, right? That can be software-defined networking, software-defined storage. Customers are really looking for ease of software versus having big footprints in their data centers that they need to then go and manage.
And Bob?
It is easy to be humble on this panel. So we are, Stratum Capital is a new modern private equity firm, just 2 years old, focused exclusively on the business IT market. Couple of themes about what we're doing. It's a lower middle market focus. We are looking at businesses that need more than just capital to get where they're going, typically control deals. And I think one of the perspectives I'd like to add today is sort of what's happening in the technology market. Technology is not just a vertical, it's a horizontal. And people who work in a particular industry where IT is not affecting what they do are certainly in a minority. But we also see a lot being written about what's happening in technology, whether it's the headlines on the Square IPO and pricing or other things. So it seems to be on the tip of the tongue. And to the extent that I can contribute some perspectives from what we're seeing day in and day out in terms of the IT market from a private equity perspective in the middle market, hope to add to the panel on that front.
Thank you, Bob. And I'll give a quick intro on Katz-Sapper & Miller. Katz-Sapper & Miller is a full-service 330-person CPA firm. That is a CPA and consulting firm with offices in Indiana and New York. The markets we consult with are the middle market, and in that market, we cover the middle to the lower sectors. This year, we have advised on over 20 due diligence projects based on both on the buy and the sell side. Most are requiring QOE reports. Our due diligence cycle with our clients usually begins pre-letter of intent, LOIs. Then we perform the due diligence, and we continue and advise all the way through to the purchase agreements. And we also utilize multiple teams at any given time during the year. All right, done with that. Now, before we start our discussions, I want to go through a few numbers related to the first 3 quarters of 2015 versus 2014. For the first 3 quarters of 2015, there were 1,439 deals. These are all U.S. middle market deals that were closed compared to 1,528 in 2014, a decrease of 89 deals from the year before. That's not alarming since 2014 had the highest number of deals since the recent recession. I'm going to now go into sectors. So for the lower middle market, where deal sizes are defined as those between 25 million to 100 million, for 2015, there were 443 deals versus 534 deals in 2014, a drop of 91 deals. The average deal size per quarter for 2015 ranged between 43 million to 29 million, versus for 2014, it was 46 million to 39 million. This indicates a trend that the deal sizes are decreasing in 2015. Remember when I'm saying these are just numbers, that's not indicative of necessarily people's experiences, which I'm going to get to. For the core middle market, where deal sizes are defined as those 100 million to 500 million, for 2015, there were 774 deals versus 754 deals in 2014. That's a slight decrease of 20. The average deal size per quarter for 2015 ranged from 184 million to 150 million. For 2014, the range was 197 million to 184 million. So if you heard me, because I'm just spilling out numbers, the lowest quarter for 2014 was the highest average for 2015, again indicating a trend that the deal sizes are decreasing. For the upper middle market, where deal sizes are defined as those from 500 million to $1 billion, for 2015, there were 223 deals versus 240 deals, a decrease of 17. And the average deal size per quarter for 2015 was 553 million to 445 million versus 642 million to 564 million. Again, same indication. So based on the numbers that I just provided, can each of you give us your opinion if these numbers are indicative of the trends you are seeing, and if not, what are you seeing? So Bob, I'm going to let you go since you're on the other end.
All right. Let me start high-level IT technology trends. First one I'd leave you with is, just as Jennifer said, there is a massive shift going on in terms of how people think about their technology. We read about the cloud, we hear about the cloud. Fact is, in the US private sector now, a quarter of all capital spending is on IT equipment. If you look just at equipment spending, it's half of US CapEx on equipment, and the other half is fracking, medical, ag, everything else. As an economy, we can't spend more on this equipment, and norms are changing in terms of how do I run my IT. Away from, I'm going to buy the hardware and software and hire the people and run it myself, and towards this idea that selectively I should be outsourcing this. As that shift, the last thing I'll say is 85% of corporate compute is still done on machines that corporate America owns themselves. So for all the hype about the move to the cloud, we are still very early there. As that compute moves from I'm going to do it myself to, selectively I'm going to outsource this, it's giving rise to a huge universe of businesses that are the outsourced software and other service providers. And that group of companies needs capital. Some of them will raise capital in the public markets, although the trend has been that the private markets are providing much more capital than the public markets into the technology sector these days. This year, it's almost 3 to 1. Some are appropriate for the early stage venture community. Some will have a corporate sponsor parent who provides funding. But a lot of these people need capital to build the data center, write the hardware, write the software, hire the people. And it is a huge universe, about 10,000 companies. That's the universe of companies that we're looking at. And so when I think about trends for this coming year, there is a real role for the private equity community to play in this private technology industry in the US, some of which is buyout and some of which is growth capital. And we often see those two bundled together. A control acquisition for a company that also needs a chunk of capital to complete an acquisition or invest in growth.
I'm going to jump around. So John, you want to weigh in on this? What do you see?
Sure. I might talk more about the numbers that you were mentioning, Corey. And I think from the point of view of a firm like either Castle Harland or Branford Castle, these changes are almost essentially unnoticeable. In other words, the fact that they're a few percent smaller and there have been fewer deals done is not something that is very obvious. The thing that may have changed, which is most important between 2014 and 2015, and I'm particularly thinking about the last quarter or so, is that because of the disruptions in the stock market that took place in August, I think funding of companies is a little less available than it was before, or the multiple that you could get. I mean, in 2014, the debt levels that were available in doing transactions was extraordinary and probably too high. And so you had deals that were being done with 6 times leverage or even more in some cases and so forth. And with the collapse of the stock market that took place in the late summer, the multiples of debt that are available are somewhat restricted. There's certain segments of the debt market that are actually shut down. Things that relate to oil services and so forth are probably shut down at this particular point in time. And as a result of that, I think that there may have been some deals that were deferred that might have been done if the debt levels were as high as they had been before. The prices might be somewhat lower, as you know, in the private equity area. Prices are heavily a function of the availability of debt, and if you can borrow 6 times, people are more likely to pay 9 times or some very high multiple. If they can only borrow 4 times, well then maybe prices will be down by that amount. So I think that there is been just a little dampening of the verve of the market that's taken place. The men on our team, and ladies too, have the one remark that they have made is that they think there may have also been something more of a diminution in terms of quality of companies that are being offered into the market. The people who are still going out on average, and this isn't to say there aren't some terrific companies out in the market and so forth, but on average those companies are probably not quite as good as they might have been 12 months ago. And basically, if you have a really super company, you may defer going to the market. You hear that the debt availability is restricted, so you hold up as opposed to marching ahead. So I believe most of this is nuance. You need a microscope to identify these trends. But there's probably some diminution of price, probably some diminution of quality that has gone along with the statistics that you mentioned.
And then I'm going to move on. Would you say that's amongst all 3 sectors, or would you say that's more concentrated in the lower sectors?
I would say that those comments are all 3 sectors, but they may affect the somewhat larger deals even more, because the larger deals are the ones that tend to it's above $200 million or so that you tend to have public debt markets, public bond markets be a factor. And those markets, I think, have been juggled more by this than other financing markets. And so I think I haven't done a study here, but I think there's some likelihood that it's the somewhat bigger company that has been affected more than the somewhat smaller company, the company that would have gone into the public junk market to get funding for a deal.
Thank you, John. Savio?
I, by and large, agree with John about the recent trends. I think partly the investment bankers have done a very good job. The market is quite efficient, so you do see the quality deals rushing out very early on, and now the quality is down somewhat. So I pretty much agree with the trend, but I just want to point out a couple things that I think are interesting and obviously to you. One is the roll-up strategies. Sponsors are all doing roll-ups, so they don't mind to buy a company and pay maybe a higher price, but then they will just focus in adding on and tuck-ins and synergistic combinations. So that I think it's a trend that will, I think, continue. The other trend is a little bit annoying to me is that the mega PE funds are coming down to the middle market. I see many signs of them willing to chase the core middle market transactions. So it's getting a little crowded for us. From my standpoint, we don't really look at some of the macro trends. To us, really generating the alpha is to find a good deal and work at it, and then exit, return good money to our LPs. So we don't see that as a big concern today. I think the market is stable. I think we do have to get out there more proactive in finding opportunities and then have the right operating skill set to do all the so-called value enhancements. The last one that I want to mention is that I like tech. I like cybersecurity. I think that still has more tailwind. Not just looking at what you read in the newspaper today. I travel throughout the Middle East to Asia and China. I do see them now trying to catch up in terms of the cybersecurity product and services. Just as an example, recently in Hong Kong, there's a big issue about this credit cards that you just touch the machine and the charges will happen. But what they don't realize, a lot of that, I have an Apple app. I can scan the data on the credit card without touching the credit card. So all of a sudden, 7 million people panic about their data being stolen. So I think just like the US government lost millions of their employee personal data. So I think that trend I specifically want to sort of call out as an interesting sector. But I think the trend is, to me, the trend is stable, but really, I don't care.
So that was a good setup for Jennifer, you know.
Yeah.
So let's get the perspective from
I
the
did
strategic.
that for that reason.
Yeah, so I think specifically from the tech market, right, a lot of the companies that EMC would be looking at right now are not going to be the mature companies with EBITDA, right? I think we were talking on the phone earlier, and we were talking about EBITDA multiples, and I kind of chuckled to myself because I said, I don't think I've seen an EBITDA multiple for the companies that I've acquired in the past 12 months, right? Because if you're looking to invest for that third platform, a lot of the companies that you're investing in are venture capital-backed startup companies. And I've recently worked on a couple of transactions that were even acquiring companies pre-revenue, right? So some of these trends, I think we keep these, from a strategic perspective, we keep these trends in the background. But the dynamics of some of the stuff that I'm dealing with are slightly different as we think about valuations. For those of you familiar with the venture capital world, there's a lot of money being thrown around to some of these tech startups. And a lot of really high valuations for some of these companies. You all hear about the unicorns in the tech space, these private companies that have $1 billion plus valuations. And it's an interesting time right now because it's not clear that the IPO market is open for some of these tech markets, right? I think you had some recent filings from Mimecast and Square that came out for some tech IPOs recently. Prior to that, Pure Storage was the most recent IPO from a tech perspective. And some of these IPOs you're seeing are going out at below their last post-money round, right? So it's creating an interesting dynamic in the market in terms of where valuations are being set and how people are able to react. And I think from a strategic's perspective, yeah, the mid-market valuations are interesting in terms of where people are acquiring, but some of these billion-dollar unicorns that have interesting technologies are falling way outside of the mid-market range, but are also falling outside of a strategic range in terms of models that you can make sense of. So how do you take a company that has no revenue, that's asking for $1 billion plus from a valuation perspective, and justify that to your shareholders, right? So those are some of the things that we deal with on our side. And I think another interesting point, less in the mid-market, but more in the tech space, is the tech market, as it goes through this shift, is also going through a massive consolidation. So a lot of the prominent tech M&A transactions that are taking place in the space right now are very large consolidations of mature companies that are either being taken private or being combined with other large companies. And so as we look at kind of the money being spent, you know, there's a lot of money being spent in tech. It's not being spent, it's being spent on more of these consolidations. And if you think about the huge dollars that are being thrown around, a lot of it is not going to these VC-backed firms. I guess one data point I'll leave you with is EMC recently did a transaction of a company called VirtuStream. It was a $1.2 billion deal. That is the only $1 billion plus transaction that has happened this year for a VC-backed company. That is typically unheard of in the tech space as you think about M&A and acquiring some of these tech companies.
So in the essence of time, I'm going to make a statement, and then I want you all to just forecast for 2016, and then I want to go to Q&A. But I read in an article that a good portion of the deals that happened in 15 were add-ons, strategic buys, not as much buy and builds. So give us your perspective of what you see in the M&A space in 16, and what your thoughts are. So Savio, you want to lead it?
Yeah, I think 16 will be pretty good for the U.S. middle market private equity. I think we do have to be careful to pull the trigger because prices will be high. The margin of error is very thin. But I see pretty good deal flow in the community. So I see interesting, and of course I predicted that cybersecurity tech is a good trend. I also think that Marshall talked about cross-border. I think that's an area that we have to be a little bit more focused on it. I think the middle market sponsors and GPs tend not to be very cross-border oriented. I like to think that InvestCorp has been very international. We do investments looking at the international opportunities. So I think definitely there will be more FDI by Chinese. I do get visited by them often. At least twice a month I get visitors who are interested in co-investing with US sponsors. The other trend is, I would say, the bank financing is going to tighten up. So we should also be thoughtful when we do the acquisition and how we capitalize it. We are starting to look at a lower leverage. I think John is a believer in that, so that we have the dry powder to grow the business. And
yeah, we're experiencing that right now on a couple of deals where the leverage is being challenged on some of these deals. But John, weigh in.
Well, and from my perspective, I think probably 2016 may not be quite as good as 2015. It may be a little more difficult getting money. Prices may be a little bit lower. But I don't see the fundamental things that take place that are going to result in massive recession in the United States, or I don't see this as a sea change year. I see it maybe as a not quite as good as last year, but a modest change. In terms of the cross-border thing, it is interesting. We've had partners in Europe as well as we have a strong relationship in Australia, and I've felt for a long time that the solution to the world was to buy in the U.S. and sell in Europe, or buy here. And actually we've done that. We had a company called United Malt, which, as you recall, one of the key ingredients in making beer is malt. And we were able to buy it inexpensively here and sell it on a much stronger basis in Australia, where there was so there are real arbitrages that take place. There's sometimes arbitrages that take place in the financing world, where money is either more available at better rates in the U.S. or elsewhere, and as a result, you move to the place in the world that has the lowest cost financing. So I sort of think that next year's going to be kind of a little bit more of the same, but maybe not quite as good.
So Jennifer, are you guys, to John's point, he brought up a good point. Since the dollar's so strong, there's opportunities cross-border right now, and we haven't had the dollar this strong in a long time. Are you guys considering that?
So
And go back to the original question, sorry.
Yeah. So I guess to answer that question from our perspective, we're going to look at things in terms of where do they strategically fit and align to our business, right? And if that is a U.S. company, great. If that is a cross-border company, great. We have a strong presence in Israel. We have done a number of transactions in Israel, and we've done a number of transactions, in Europe and other areas. And so I think to the extent that there are quality candidates that fit what we're looking for from a strategy perspective, we would consider that and we would take a look at it. We don't look at it as, the dollar is strong, so we're only going to do cross-border transactions. I mean, from a strategics perspective, it truly becomes, what is the strategy? Where are we investing inorganically? And how do these companies fit into that? So to that question, I think to the broader question to the group, I think slightly different from the others in terms of predicting 2016. I think from our perspective, EMC has always used M&A as a core tool, I would say, to invest and differentiate our offerings in the market. We have what we call a dual investment strategy, which is R&D and M&A. We spend 12% of our revenues in R&D, and we spend 8% of our revenues in M&A. So we call it that dual strategy, and I believe we will continue to do that. Now, in terms of what 2016 brings, right, that comes down to quality candidates in the market, and it comes down to valuations. For me to stand up in front of our M&A committee and tell our M&A committee that I need them to spend X number of dollars to acquire a company, I better be able to justify that from a shareholder perspective. Because if my shareholders can't make a return on that investment that they could make in other areas of the business, whether that be investing further in R&D, whether that be share buybacks, whether that be dividends, we need to be able to make those models work. So I think valuations will play a big part of what that looks like and how we can be active in the M&A space in 16.
Thank you. And Bob?
I would say we hear a rising tone of the sense that while people may not know where we are in the cycle, it feels late, and to pay way up for uncertain future growth feels a little uncomfortable. And so I think to some of the trends we heard about, I would expect a little bit less of this piling on for very high valuations in pre-IPO financings, particularly what we've seen in the IPO market recently. When you look at the active areas in technology, they've been software and data rather than hardware or communications or other areas. And those are areas that have very compelling consolidation economics. So I think you will continue to see a steady stream of tuck-ins because of the nature of the industries that have most of the activity.
Great. So I'm going to open it up for questions. Go ahead.
Question for Jennifer. So you mentioned IPOs at valuations below the last private market round. Are those investors in those private market rounds all protected from an anti-dilution or valuation provision?
So hard to say. Not all of that's public, right? We are seeing unique things in the market in terms of the last round investors coming in are starting to try and negotiate some of those protections, right? I think Box was an example of investors that had done that. So I can't speak for all IPOs or all private companies that are out there, but we are seeing more of that in the market on the venture side. And Bob may be able to talk to this more than me.
Let me offer one thing. It all gets converted to common, so someone's being diluted down, and it will vary case to case. If the person is getting, less than the price that they paid because they didn't have those protections, that will chill their desire to do the next one. If they were protected, the existing shareholders who thought this is going to be such a genius idea to go raise this Series G preferred at this really high price, oops, I took the dilution when that person needed to be protected because we couldn't actually go public, we'll be a little more cautious about deciding, hey, it's a really good idea to go raise highly structured but high convert price capital. So I think whichever way it goes, you'll see, a little bit of a chilling on those type things.
And that becomes toxic on most deals. So, go ahead. Yeah.
Question for Jennifer and Savio. Question for Jennifer and Savio. Basically, you mentioned that one of the sectors that you like, obviously, is cybersecurity. Being a banker in TFT for 15 years, I've seen the bubble of internet, the bubble of RC fiber optic cables. So now that governments are hacked, corporation banks are hacked, everybody is like putting tons of money in cybersecurity. The question is, who are the advice, technical advice that will tell you, this is the right technology to invest? Even though the hackers are getting more intelligent and are all over the world.
So is your question, if it's cybersecurity advising?
Yes, who are the advisors of not only the financing, the telecom bankers, but who are the technical advisors that you have to pay attention on the investments that you're going to do?
So
Yeah, so
my side may be a little different, right? Because we don't even have advisors, right? We have a security division of EMC.
Right.
And that security division of EMC has a set strategy, which is predominantly focusing on network security. So being able to understand what's going on in your network, who's penetrating your network, should those individuals on your network be on your network, those types of things. And identity and access management is a key component of that. In terms of advisors on cybersecurity, right, I mean, we have a strategy team at RSA that's looking at where the market's shifting and where we want to focus, and that's what they're doing.
Let me change the question slightly, because you basically started with a bubble. Are you asking, is there a bubble potentially coming out of cyber? Let me ask the question, because it's a little more creative. So is there a bubble potentially in cybersecurity that you foresee, and could it be down the road 3-4 years? Let me ask that question. So that's for Savio and anybody else that wants to chime in here. So.
Sure.
Well, I think technology is not a bubble investing, right? I think technology has been with us for a long, long time, and it will make us do things better. A personal bias is that I like business technology. Just like Bob said, he's not a venture capitalist. He's into a private equity, a company with EBITDA, with cash flow, but it's in the tech sector. So to me, cybersecurity is not a .com strategy. It's just part of how we do things every day. And we are now living in a world that we have to be much more heightened on the surrounding and on data and on protecting the business. So I think that's a trend. It's not like, of course, you're always going to come up with someone with a pretty cool app on cybersecurity, but that's not what I'm referring to. Right. I'm talking about companies like Sophos, like Fishnet. These are substantial companies engaged in the cyber security business.
And it extends beyond, it goes to governmental, it goes to every company, it applies to even the smaller companies now, so go ahead.
Yeah, I guess one of the things that I would say in terms of a .com, and someone kind of gave me this reference, which I found very helpful, was the .com bust of like 2000, 2002, right? The commentary was none of those companies were really businesses. They didn't have a concrete offering, if you think about what they were doing in the .com era. And if you think about a lot of what these technology companies are doing today, there is actually a physical service or offering that they are bringing to their customers, right? It can be defined, and they can define what it is they're going to provide you from a security perspective or any other technology perspective. So, you know, look, I can't say whether it's a bubble or not because I don't think anyone can really predict that, but what I think you're having right now is there are a lot of very unique situations in the technology space that are warranting new technologies and new ways to think about coming at some of these problems. And you have a lot of really smart people out there that are developing ways to do that. Some of them are going to win and some of them are going to lose, right? And I think you just have to have smart people on your side informing you of different technologies that are out there and the ways in which people are going about doing that, whether that's, you know, the bet you want to make or it's not the bet you want to make.
All right, one last question if anybody has one. All right, well, I'd like to thank our panelists. We're right on time, so let's give them a hand. Thank you, everyone.